as you rightly said, if the AO was convinced of the benefit and the legitimate need, because he was supposed to follow the 40A2 condition, then there are lesser chances of it getting disallowed. But one cannot say that just because AO has not done it, the TPO may not do it. Because actually in TPO also, sir, there are various cases where earlier the TPO may not have done it. In the subsequent years, another TPO may have a different view and he is taken a different position. It's an evolving thing. So, I personally believe that you should make your case strong by putting the benefit in your documentation. Or even explaining like what you said, that over the last several years, he has been associated, this is the benefit that he is bringing. And without him not being there, because he is really the heart of the partnership. Now, if he is moved out, then it may, the partnership may not function. These are things also because just the mere presence of that person, like it's like a brand, right? You may not effectively, that brand may have, earlier had a value and now it's a routine thing. But that is important. So that way, if that partner has been there for 20 years and he's an important person, maybe not active now, but he has that name which is important for his association in the firm, then that can also be an argument.
So we cannot say that once the law has submitted this limit, it should be automatically become AND.
I don't think so, at least, unless the law, some circular comes out. Because that way there is, when you pay royalty payments, in international TP it is as per RBI limits, right? But there are several decisions which say that TP is to determine what should be the value. RBI has an upper cap. So there are so many such, even interest, for example, there are limits, but I don't think that may hold true completely.
Thank you. So this will be the last question.
Yeah.
Regarding managerial regulation, you mentioned apply the other method. This other method, what specific benchmark or parameters would be applied?
So you would generally see if you see the other method, it says that it's more like an indirect, uncontrolled situation. So it's more like prima facie, like even not an actual transaction. But generally from the market you know that the person may be available at so and so range of firm with so and so years of experience. There are these HR studies which are done generally. Person with an IIT background, person with an IIM background, with so many years of experience would generally be paid an X amount. So there are various such studies available in the open, and if one does little research on that and if you can come across that, in fact, a lot of large good corporate groups also internally in their HR, they do their own HR studies. And if they're not doing one, I think you should always, now with SDT being in place, it's important that you get one in place. You have a lot of these independent HR agencies who do a benchmarking for the senior people. That okay, based on this and based on the market, what is generally the band? That study doesn't cost a lot. If that kind of documentation you put in place, it may help you to justify.
Sorry, David. When the tax effect is nil, what is the impact of this domestic transfer pricing? When a remuneration is paid to a director or any purchase sales is made to a related party concern, both are at the same slab rate. Then what will be the impact?
So the intention of domestic TP was to cover where there is a differential tax. Okay, that was the intent. But the wording of the law is not that way. The wording of the law says that you need to cover these transactions because there may be accumulated losses. There could be, one entity could have an effective tax rate which is lower than the other. Both may have a different, but ultimately you are talking about effective tax rate.
It is nil. It comes nil.
For example, a trust.
A remuneration is paid to a director.
Okay.
He is paying tax at the same rate. The company is paying tax at the same rate. Even no remuneration was paid, the tax effect would have been same. On the contrary, madam, now the remuneration, if the income exceeds 1 crore, the surcharge will have to be had. Whereas in the case of company, the surcharge is lower. It may be possible that in certain cases, the directors, the remuneration received are paying higher tax. Then what will be the impact? Where also all this justification will be required to be done.
See, there you can give this kind of an argument. You need not get into detailed justification. But the issue will be more for, say, promoter directors, where they are also having shares. Then the whole idea and objective of covering this was that whether in guise of dividend you are paying them remuneration. Because the point is that if you would have paid dividend, there would have been dividend distribution tax. But in this situation, and plus you would have also claimed a deduction under the company. So if you are paying more, what is happening is you're claiming a deduction under the company. You're not also paying dividend distribution tax because otherwise you would have given a dividend. So the intent was to really capture these. Now how do you capture this? So if you let's understand that the objective was not to really cover the whole gamut. But unless you don't cover, then one cannot just pinpoint this and say that in the law you should only cover these kind of transactions. Either you cover or you don't cover. Doing an in-between thing, as you said, that whether the effective tax rate is nil, not nil, would be a much more onerous task and responsibility on the chartered accountant in each case to see whether that transaction has a tax neutral impact or not has an impact. Now that you can leave it to scrutiny. I mean, at the end of the day, if it's such a genuine case as you're saying, then the AO will anyway not have a problem, or the TPO will anyway not have a problem.
And whether past payments will help them, past recognition is now what they have been consuming, or the increment which is just promotion to that stage and all that assessments have been accepted in the past, this payment of remuneration on that. All that will help.
See, that will always help, but there's principles of res judicata do not apply, right? There are so many case laws which say that. So the point is that one can always, you can argue that if the facts are the same, if he is doing what he is doing then and now, the benefit is the same. If earlier it was allowed, then why it should not be allowed? But there it will be important to demonstrate that the facts are same. If you can establish that the facts are same, then you have a good case. Okay, so thank you everyone. Thanks a lot.
I think we had very good 2 sessions today morning, and they deserve a definitely well-deserved vote of thanks. First to Madam Mati Sridharan. She has spared her valuable time and despite her busy schedule, come and express her thoughts. She said that people outside India have got more experience, but Madam, I can assure you that the tax department and the tax professionals will very soon catch up with them and come up to that standard, and in fact others will look towards us just as they are doing for international tax provisions. Thank you for advising that we should bring the assessing also to the assessments, and wishing the domestic firms a very right practice. I request all of you to carry the vote of thanks for same for Karishma Secretary. She has given an excellent overview of the domestic transfer pricing provisions and brought out very important pitfalls which one should keep it in mind while advising our clients, and of course for compliance with the provisions. And we are also thankful to her for designing the program and also coming and giving us a few thoughts over there. I request all of you again to give a very Friends, we'll break for tea for 15 minutes, and the tea will be served near the entrance. Let us begin our second technical session. We have with us a very learned faculty, Sri Nihar Jambusaria, who most of us know, and we can listen to him on the issue of section 40A2, which typically deals with expenses which are paid to related parties. As you know, the section covers different kinds of related parties related directly or by way of having substantial interest, either the payer has it or the recipient has it, either way. This is different from the meaning of associated enterprises, which is their international transfer pricing provisions, and how is it different, he will explain it to us. We have the phrase of beneficial owner in this section, which has not been defined. Does it cover direct ownership or does it cover through intermediate companies? These are some of the issues which we have in this particular section. I had a quick look at the presentation, and he has covered several such issues, whether 48 applies, not applies, substantial interest and things like that. Just one observation, while coming today to this conference, I was just having a look at a few provisions of the Companies Act 2013, where also we have issues related to related party transactions, and we need approvals by way of special resolutions for certain kinds of related party transactions. But one of the exemptions given in those provisions is that if the transaction is in ordinary course of business and on arm's length price, then it does not get covered by those provisions of the company law. I don't know whether satisfaction of arm's length price provisions over here will therefore satisfy provisions under the Companies Act or not. Friends, without taking more of your time, I request Namrata to introduce Mr. Nihar Jambusaria formally and then take it forward.
Thank you, Naresh sir. As he already said, most of us already know CA Nihar Jambusaria. Despite, I would like to introduce him formally for the purpose of this forum. Shri Nihar Jambusaria is presently the Senior Vice President of Taxation at Reliance. Prior to that, he was in practice the National Head of Tax Advisory Services in video consulting and also a partner in Nihar Jambusaria and Company. He had been in practice since 1984. He was also a lecturer and head of Department of Accountancy at DTSS College of Commerce in Mumbai. His area of expertise has been advising on domestic, international transactions, inbound, outbound structuring and litigation throughout Australia. He has been elected as a Central Council member of the Institute of Chartered Accountants of India for 2012 to 2015 tenure, and he was the past chairman of the WIRC. During his 6 years regime at WIRC, he has regularly been active in making representations to CBDT, to the Chief Commissioners of Income Tax, etc. And he has been regularly in touch with the profession by presenting more than 300 papers on various subjects of professional interest, including direct taxes, accounting standards, IFRS conversions, etc., at different forums. With that, I request you all to join your hands to welcome our speaker, CA Nihar Jambusaria. Before we proceed to his presentation, I would request President to present us with a memento as a token of our appreciation. Sir, we would begin with
President of the Chamber, Naresh Bhai, Bhavik, Namrata, and friends. In fact, in overview, some of the issues related to Section 48 to the double, I think to that extent my dollar is reduced and we can reserve some more time for question answers. I will touch upon those issues also because there are one or two more additions or supplements that I would like to add in those issues. But otherwise my mandate is to deal with Section 48. I was only wondering when Madam DI was mentioning to us that the department has learned so many things from BD professionals. The only point is if you look at the checkered history of assessments, particularly transfer pricing assessments, over the last 5 years, then in the first year of scrutiny, the additions were to the tune of around 750 crores. And in the last financial year, the department made adjustments of 40,000 crores. I think the Supreme Court judge's remark in GlaxoSmithKline is not instrumental to introducing these provisions, but probably the Finance Ministry thought that if we are able to make this kind of adjustments in international transfer pricing, let us introduce even domestic transfer pricing. And the two previous speakers have mentioned several times that these provisions are very subjective. If we are strong on facts, we can defend the case well. And the facts only, in my experience, can protect us rather than application of formulas and different methods and justifying the method that we apply in computing the arm's length price. So let us take clues from that and take this very seriously. Some of the questions which were asked were very pertinent. Some of the participants were agitated on section 40B, that where the section specifies 12% per annum as the permissible rate of interest payable to partner. How can there be a separate benchmarking under 48? We will deal with these aspects later in the session when we come to justification and benchmarking. But these are definitely very relevant. We do not know whether promises made by the government at the time of introducing 40B will be honored now that transfer pricing provisions are applicable, and there are another tool over and above 40B in the form of 48(2) or transfer pricing provisions to make the adjustments. So keeping this in mind, let us just have a look at these provisions first. I will again give an overview of some of the provisions because they are very much relevant in our discussion. Now, first of all, section 92DA covers what category of transactions? It covers any expenditure under section 48(2). It covers transactions referred to in section 80A, 80IA8, 80IA10, 10AA, or any other transactions which may be prescribed. Now, out of all these, I will cover expenditure under section 48(2). Post lunch, there is a separate section on 80A, 80IA8 and 10, so I will not touch upon them. Any others as may be prescribed. So far, no other transactions have been prescribed. So I will cover 48(2). Now, transfer pricing regulations, both procedural and penal will apply only if the specified domestic transactions put together exceed 5 crores of rupees every year. Now, many had raised these issues that 5 crores is a very low limit, but we cannot do anything to it for the time being for the first year. We do not know whether for subsequent years the government will accept our presentations that this should be more than 5 crores, maybe in the range of 15 to 20 crores. There is one more point. A question was raised whether if expenditure paid is found to be excessive, and assume for the time being that it does not meet the case document transfer pricing, and the other entity is also paying tax at the same rate, whether addition will be justified. This question was raised. I think addition is permissible. In that case, there will be double taxation, but one can't avoid it if you look at the current provisions. In fact, last year when this was introduced, 2 representations were made to the finance minister. Number 1, transfer pricing provisions for 80IA and 10AA are justified, but 48(2) should not be covered for the simple reason that even if suppose the payer and receiver are paying tax at different rate, probably now if you look at these transactions beyond 5 crores, normally they will be between companies, and if suppose one company is covered under VAT, another is covered under normal tax, ultimately in the long run such companies pay tax at the same rate. So in that case it is only a question of postponement of tax liability by making adjustment in the form of paying excessive expenditure to a relative. And another representation was made that suppose this is not acceptable, you find that another entity, the entity to which payment is made, is paying tax at higher rate or lower rate, and therefore you feel transfer pricing should be applied, at least there should be a clear proviso, clear carve out. In case where the two entities are taxable at the same rate, these transfer pricing provisions should not be applicable. Now, if you look at practically applicability of these provisions, then to big corporates and big taxpayers, this may not create much of difficulty, but for smaller taxpayers to benchmark, to apply, select a particular method, to maintain documents, and that too in physical form for a period of 8 years, I think it is going to create a lot of difficulty. But now, given these difficulties, I think we have to implement these provisions, execute them, and we are left with less than 2 months' time now. Before I start with the provisions, one more aspect that I would like to deal with, and it is only an informal suggestion, that it is better if we start uploading these reports as early as possible. You have seen the experience on tax audit reports, that in the last 3 to 4 days, their website was not working, it was not taking the load of the returns that were being uploaded. In spite of that, they did not extend the date. And today the writ petition filed by some societies consisting of